Today, we're diving deep into a crucial aspect of the financial markets that every trader should be aware of: inducement zones. These deceptive areas on the price chart are strategically crafted by institutional players to lure unsuspecting traders into traps. Inducement zones are a hidden weapon used by institutional players to manipulate market sentiment, and they can turn a promising trade into a nightmare. In this video, we'll unravel the secrets behind these inducement zones, understand how they work, and most importantly, equip you with the knowledge to protect yourself from potential losses.
If you're frustrated by losing streaks and wish you had the guidance of a professional, I've found a solution for you. Forget about uncertainty and blown-up accounts. From now on, you have the opportunity to follow the strategies of a professional options trader who gets a consistent 80% plus win rate. His signals are highly accurate, and the process is very simple. All you need to do is attend daily live streams during market open and enter and exit trades, along with Winger in real time. In addition, you'll learn high win rate strategies that have been proven to work.
Welcome back, traders. So, let's get started. Inducement zones, also known as liquidity zones, are areas where market participants are induced to enter or exit trades due to the presence of significant liquidity. These zones often represent areas of high buying or selling interest and can provide valuable insights into potential market reversals or continuations. So, what is the exact definition of the inducement? Inducement zones occur at specific points or areas in the market where traders believe it is the right time to enter a trade based on their analysis and trading system. These zones are strategically used by central banks and large financial institutions to manipulate and lure retail traders into their traps. The purpose of inducing traders into these zones is to create liquidity and attract more buyers and sellers. Once a sufficient number of retail traders have taken positions in the direction perceived as favorable, the market is swiftly moved in the opposite direction, resulting in a significant reversal or breakout. This sudden move catches many retail traders off guard, leading to stop-loss orders being triggered and adding to the liquidity that the smart money players sought to exploit. Most of the time, inducement zones tend to appear at specific points and zones in the market. These areas often include order blocks. Areas where significant orders have been executed or pending orders are clustered can act as liquidity zones. Hence, inducement often takes place within order blocks, which are areas where market manipulators create false moves or reversals to deceive traders and induce them into taking positions. For example, as you can see here, price after formation of the BOSs to the upside and also generating bullish order blocks has pushed to the downside and tapped into the upper bullish order block, and after showing a tiny pullback to the upside, sharply dropped to the downside. It is obvious that the market did not respect the upper order block. Instead, the price dropped sharply and swept the liquidity resting below this zone by triggering the stop losses of traders who had entered the market at this level. After successfully sweeping the liquidity, the price used the upper zones as inducement levels. It then reversed direction from the extreme order block and exhibited a strong upward movement, continuing the bullish trend with significant momentum. Number 2 is dynamic trendline and channel breaks. Inducement can occur when a dynamic trendline or channel is broken, leading traders to believe in a strong directional move. However, market manipulators may exploit these breakouts to trap traders before reversing the price. When a trendline or a channel is broken, it can create a sense of urgency among traders to enter positions in the direction of the breakout. Market manipulators may induce a false breakout to trigger a surge of buying or selling before reversing the price in the opposite direction. As you can see here, we have a bearish dynamic trendline that the price has respected multiple times. This trendline has created a significant liquidity zone above itself, resulting from the stop-loss orders of traders who entered the market with sell positions, expecting the price to reverse to the downside each time it touches the trendline. These traders also anticipate a buying opportunity if the price breaks the bearish trendline to the upside. However, as you can see, the price was artificially pushed to the upside by market makers using a large red momentum candle. This sudden upward movement resulted in the sweeping of the significant liquidity that had accumulated above the trendline. As a result, the stop losses of retail traders who had entered the market with short positions were triggered. Additionally, this breakout generates excitement among more traders, leading them to believe that it's the right time to ride the upward wave. They place their buy orders and enter the market, while also adjusting their stop losses below the trend line. creating a potential target for the price. However, as you can see, the price swiftly reverses and moves downwards with large momentum candles. In this scenario designed by market manipulators, both buyers and sellers' stop losses are triggered, allowing the market to absorb a significant amount of liquidity and fuel its momentum.